Good morning, students. Welcome back. So we have been discussing about employee benefits. So today we plan to wrap up this standard one, and we'll also start with a new standard today. Okay, and that will be about provisions. AS29. Yeah, but there are few aspects related to AS15. I think in terms of the topics we are done, but in terms of the questions, it's better we practice some more, right? Okay, so what we can do is we can just pick up maybe this illustration 9 first to begin with. Okay, so let me just share this document with you now. So we discussed about post-employment benefits, other long-term employee benefits, and we also talked about termination benefits in the last session. Okay, as regards other long-term employee benefits, termination benefits, you would have seen that the accounting requirements once again are comparatively lesser. Why? Because when it comes to this post-employment, that is where you have this segregation, okay, into defined contribution, defined benefit plans, and that is where we get into all of these calculations and all, right? Now what we will do is we'll pick up few questions on all of these topics. Yeah, it's a sort of mixed up. So we'll pick up questions on other long term, short term. Yeah, so just to practice. Okay, and I would appreciate if you can just alongside solve all of them, share the solutions. Okay, that will be helpful, and that will also give you more clarity of the concept. Okay, further as regards your chat, I would appreciate if you can just share the messages in the chat for everyone because it becomes easier to track. All right, so let's look at this question now. An employee Roshan has joined a company XYZ Limited in the year 2000 X1. Okay. Annual emoluments of Roshan as decided is 14,90,210. These are the annual emoluments. Emoluments you can say is the salary, the compensation. Company also has a policy of giving a lump sum payment. So this is included in the HR policy. What is that? 25% of the last drawn salary for each completed year of service if the employee retires after completing minimum 5 years of service. Okay, so you can say this is a benefit which the company provides. Correct. Now, it is expected that salary of this employee Roshan will grow at 10% per annum. So you can say year on year, this is the increment or the growth which is expected. Company has inducted Roshan in the beginning of the year, and it is expected that he will complete minimum 5-year term before the retirement. So that's why what will happen? If the employee will complete minimum 5 years before the retirement, so therefore Roshan will also become entitled to this lump sum payment. Yes or no? Yeah. Now, what is the question? What is the requirement of the question? What is the amount the company should charge in its P&L each year as a cost for defined benefit obligation? So the moment you have this term defined benefit obligation, what does it mean? It means we are talking about post-employment benefit. Yes or no? Yeah. Also, calculate the current service cost and interest cost to be charged per year, assuming a discount rate. Now, what is the discount rate? Interest rate. Now, in this question, actually what we are required to do is we are required to get on to some of the calculations. Okay, so it's not really about the accounting. Actually, it's more about the calculations, which is helpful. Why? Because all of these components we understand. So current service cost, we understand what is that. Yes or no? So when it comes to a defined benefit plan, we discussed there could be a current service cost. In some of the cases, there could be past service cost. Current service cost will always be there. Yes or no? That will always be there. Past service cost may or may not be there, but that can be one of the components. What are the other components? Actuarial gain or loss. That will also arise each year. And interest cost. Why? Because you record this liability at present value. That is also something we discussed. Therefore, each year, what do you do? On the liability, you will compute interest. And if you compute interest on the liability, what does it become? Interest cost. Now, for computing the interest on the liability, what do you need? Interest rate. So that interest rate is called as discount rate. Okay. Now, for your purposes, because you are required to compute the present value of the liability, this PV factor is given to you. Okay. Now, what is the PV factor? If let's suppose rupee 1 is discounted to today's date. So what is going to be its value? Yeah. For all the 5 years, this calculation is already done. So you can say that's an additional benefit sort of, which is provided to you. Question is not asking you to compute it. It's already computed for you. Okay. So now quickly over to you. So if you can just start solving this on your own, I will also be getting onto the solution now. But if you can just start solving this on your own and start sharing the final answer, which you compute. Okay. But I would appreciate that you start solving this on your own. And let's not get on to the solution that I am now referring to. Yeah, that will be helpful. That's how you will get practice. Yeah. Okay. All right. So now let's look at the solution. Those who are not solving, but I would appreciate everyone should solve. But if in case you are not solving, you can just get on to this solution now. Now, in this case, what are we required to do? We are required to compute amount that will be charged to P&L. Yes or no? So that means cost is required to be computed for each year. Now, if you look at the benefit, what does it say? Lump sum payment of 25% will be given. And how do you compute that? Last drawn salary of the employee, last drawn salary of the employee, annual salary for each completed year of service. Okay, so now, if let's suppose this particular employee will work with the company. So at the end of first year, what will happen? Salary will grow by 10%. Next year, again it will grow by 10%. Next year, again it will grow. Again, so in the same manner, at the end of fifth year, what will happen? This number will grow to 24 lakhs. So if you calculate this comes out to 24 lakhs. Now we don't know what is the actual number. Today we can only expect the number because we are on today's date and we are calculating this for future. Correct? So now, what is the expected last drawn salary for the employee? 24 lakhs. Okay. Now what is the benefit if let's suppose after 5 years, salary of the employee will be 24 lakhs. So the policy says 25% of the last drawn salary means 25% of 24 lakhs will be paid to him for each of the 5 years. For each of the 5 years means multiply that with 5. Okay, multiply that with 5. So that means what is the amount that will be payable to him? 30 lakhs. 30 lakhs will be the amount that will be payable to him after 5 years. Yes or no? Yeah. So after 5 years, 30 lakhs will be payable to him. Now, in this case, because an amount of 30 lakhs is payable to him after the end of 5th year, so that's why what do? Allocate this over a period of 5 years. Correct? Yeah. So if you allocate this over a period of 5 years, what do you get? What do you get? 6 lakhs each year. Yes or no? So each year, what is the amount that you get? 6 lakhs. Okay. Now 6 lakhs is the amount that you get each year. But all of these values are what? Future values. All of these values are what? Future values. Okay. So let's try to understand. In a way, what are we trying to compute here? Okay, so now we are saying at the first place 1, 2, 3, 4, 5. At the end of 5th year, salary of the employee is expected to reach 24 lakhs. Okay. Now, basis this calculation, what do you derive? Basis this calculation, you have derived 30 lakhs. Now you may be thinking, sir, if the salary is 24 lakhs, how do you derive 30? So we are saying that on this 24 lakhs, compute 25% for 5 years, for each year. Okay. So that means 30 lakhs is the amount that is payable to him in respect of this particular retirement benefit. Okay, so this 30 lakhs is what? It's the retirement benefit, which you can say is also a post-employment benefit. Correct? This 30 lakhs is what? This is post-employment. Okay, now what do we need? Now in this case, we are saying that in a way, what should we do? When we know over a period of 5 years, 30 lakhs is a cost to the company. So allocate this 30 over a period of 5 years. So what will you have? 6 lakhs for first year, 6 lakhs for second year, 6 lakhs for third year, 6 lakhs for fourth year, and 6 lakhs for fifth year. So that's how you'll allocate. Now, at the end of first year, what is your expected expense? 6 lakhs. At the end of second year, what is that? 6 lakhs. Third year, again 6 lakhs. Fourth year, again 6 lakhs. Fifth year, again 6 lakhs. So this is the expected expense. Now what do we need? We need to record an expense in the first year. Now we are looking at recording of this expense at the end of first year. Okay. So that's why, what should you do? You know that at the end of first year, this 6 lakhs is going to be the value, right? But if you look at this 6 lakhs at the end of second year, what should you do? What should you do? you should compute its present value as at the end of first year. Similarly, you should compute the present value of this as at the end of first year. Present value of this as at the end of first year. Present value of this as at the end of first year. Yes or no? You will be required to compute these present values. Correct? Okay. So Chandan has a query. Chandan is, sorry. Yes, Chandan has a query. Chandan is asking, sir, last drawn salary means? See, last drawn salary means at the end of fifth year, what is the salary which is expected to be payable to this employee? So today, what is the amount of salary? In the first year, it is expected, sorry, it is actual. Today, salary is 14,90,000. At the end of first year, what will happen? It will grow by 10%. That's why what will happen? This will increase again at the end of second year, it will grow by another 10%. Then again 10%. Then again 10%. Then again 10%. And because of this 1490 over a period of 5 years will grow to 24 lakhs. So the last drawn means the salary which this employee will be getting at the end of fifth year. What will that be? 24 lakhs. Okay. And they are asking about the annual number, not the monthly number. Clear? Chandan, clear on this? Right? Okay. I think Kuldeep has a query. Kuldeep, can you please explain what is your query? Kuldeep, please pick up if you have any query. Okay. Right. So I understand you have some questions. Let me just get done with this and then I'll come to your queries. Let's wrap it up. Then I think most likely your queries will be over. But if in case you have still some queries, I'll come to that. Okay. No worries. So let's solve this completely. Now what do? We are now required to calculate current service cost. See, each year, what did we do? We computed that what is the cost for this retirement benefit. Okay. So we are not talking about other employee benefits. See, other than this retirement benefit, employee is also getting 14,90,000, which is growing. Okay. We are not talking about that component. We are talking about only the component of this retirement benefit. What is that? We discussed each year it is 6 lakhs. Okay. So that is what we discussed. Now what do we need? We need to calculate this amount. We need to calculate this amount at the end of each year. Okay. So now what do? If you look at this 6 lakhs, okay, if you discount it to today's date, what does it become? 4,41,000. Similarly, if you discount the 6 lakhs to today's date, so if you remember, there is one which you will discount for 1 year, other one you will discount for 2 years, other one you will discount for 3 years. So that's how you will compute. Yes or no? That's how you will compute. Yeah. So if you do that, so these are the values that you compute. Okay. So these are the values that you compute. Right? Okay. Now comes the question that in terms of this interest cost. Okay. So this is your current service cost. This is the current service cost. Now what do we need? we need the interest cost that will be charged. Now for the interest cost, what do we need? Very simple. The amount of liability that we have, which is recorded at present value. Okay. On that liability, we will keep booking interest year on year. So at the end of first year, what do you have? At the end of first year, we have a liability of 4,41,000. Where do you get this? Over here. See, if let's suppose you have a cost of 441, so corresponding liability will also be there. Why? Because against this cost, payment has not been made. Yes or no? Yeah. So what is the accounting entry will pass at the end of first year? Expense debit, retirement benefit expense debit to liability. So at the end of first year, what is your liability? 4,41,000. Correct? Now, at the beginning of the first year, second year, this liability will continue, on which you will accrue interest at the rate what? 8%, which is given in the question. So if you look at the question, it says 8%. Okay, so this is the interest that you compute. So this liability reaches 4,76,400. Okay, yeah. Now, post post addition, I'm saying post interest, what does it become? 476,400. So that's the amount that it becomes. To this 476,400, what do you do? Now you will add the liability for the current year as well. Yes or no? So we have this 476,400, to which we will add the liability for current year. So what does it become? 952. Why? Because this 441 is the liability at the end of the year, which has increased to 476. At the end of second year, there is another liability that you accrue. What is that? 476,400. So if you add this opening balance, which has increased due to interest, plus the liability that you accrue for the second year, what is the total amount of liability at the end of second year? 9,52,680. Okay. So this is what you will carry to next year. So this moves on to the next year, on which you will book interest. You will book interest, correct? Now, next year again, what will happen? Next year, you will have this additional liability coming up, 5,14,200. Okay. So if you add these three, what does it become? 15,43,000. So this way it will continue each year. Okay. Eventually, what will happen? It will reach a balance of 30 lakhs. Yeah. Eventually, it will reach 30 lakhs. Clear on this? So each year, what will you have? You will have interest cost in the P&L. Okay. Which is this? Okay. This C column. And you will have this D column as current service cost. So these are the two items that will hit the P&L each year. All right. Yeah, clear. Now, any questions, any doubts that you may have, let's pick up that one by one. Okay, so now let me just go back to the working. any questions, any doubts that you may have? Let's pick that up. Okay. Yeah. So I understand Kuldeep had a query and Anjana had a query. So I would appreciate if you can just explain your query, huh? If you still think your query is there, if you're still not clear on those points, yes, please explain, huh? Kuldeep, Anjana, if you think you have a query, please explain. Okay, yes, Kuldeep, please go ahead. Yes, Kuldeep, please pick up. Yeah, Kuldeep, over to you. Kuldeep, please explain. Okay. Nisar, are you there? Please
Yeah,
allow
yeah, yeah.
Kuldeep. Yes.
Yeah, it is working, sir. Thank you.
Okay. Yes.
Sir, I want one. Good morning, sir.
Good
Uh,
morning.
so this says that the defined benefit obligation says that it is going to be given at the fifth year. And
Yes.
what I understand in the process that it is given after retirement.
Correct.
So, so it is given after fifth year, completion of
Mm-hmm.
fifth year.
Right.
So it is not contrary to what is given after retirement and after given fifth year. So I am not able to understand difference between these two.
No, so if you look at the requirement of the question, so if you go back to the question, what does the question say? Let's read that once again. Okay, I'm not running the question right now. So question says company has inducted Roshan. So if you read the second para, in the beginning of the year.
Yeah, yeah,
Okay,
yeah.
in fact, just to clarify, I'll share that with everyone.
Join the annual emoluments of
Now, if you company has inducted Roshan in the beginning of the year and it is expected he will complete minimum 5 years term before retiring.
yes, yes, yes.
Okay. So somewhere in the question, it is expected that employee will retire after 5 years. So that has become the basis of solving this. You are absolutely right. There could be an assumption that this employee completes 5 years and continues to stay with the company.
Yeah.
Okay. But in that case, what will happen? In that case, the salary which will be considered for the purposes of this calculation
Hmm.
will not be after fifth year. That will be the salary which the employee will be getting at the time of retirement, which is not known to us.
Hmm.
Okay, let's assume this employee retires after 20 years. So how will you compute this amount? You will keep picking up this growth for next 20 years.
Yes.
You will reach the salary or expected salary which will be there after 20 years.
Yes.
Okay.
Yes.
And that is how you will compute this amount. So currently the amount of 30 lakhs which you have computed. So that will be some other number. Okay. But in the question, the data, the information that is available to you is only for 5 years. Beyond that, you do not have the data. So therefore, what do? Your best assumption is what? That the employee has to retire after 5 years.
Okay.
Okay. Otherwise, you will not be able to solve this. Understood?
Okay. So after fifth year, what we are going to give is retirement benefit in this case, as per the question.
You can say that after fifth year, employee retires and therefore, because he completes 5 years, this retirement benefit becomes payable to him.
Okay. Thank you. Thank you. Got it.
Okay. And why are they specifically highlighting this point? If you read this first point, management has inducted Roshan in the beginning of the year. So this is just to highlight on the point that the employee will be able to complete 5 years and thereby avail this benefit. If let's suppose it says employee will be joining towards the end of the year, middle of the year, then you can always make an assumption, or you may have a confusion also, huh? That how do we say that 5 years are completed? Okay, so that's why they have specifically mentioned this point at the beginning of the year. Otherwise, you will pick up the questions. Nowhere do they specify when is the employee joining, on which date, or beginning of the year, end of the year. Okay, yes or no? Generally, you don't get to see that. Correct?
Okay, okay. Thank you, sir.
Yeah. Any other point on this?
No, no, no. Thank you. Thank you.
All right, great. Yes. Then I understand Anjana has a query. Yes, Anjana. Yes, Anjana, please go ahead. Anjana, you're there? You have a query? Anjana, please explain quickly, huh? Are you there? Okay, so it seems Nizar, if you can unmute Anjana, please. Anjana, please pick up. I think you are already not on mute. Do you still have the query? No? All right, so shall we move? Okay, Theosumi has a query. Theosumi, if you can just explain your query, please, quickly. Theosumi, do you have a query? Quickly, huh? See, I can see you're raising hands, but you are not speaking up. That becomes very difficult, huh? Okay, so we are through. Theosumi, you're there? Quickly, you can just speak up fast. All right, so I think Archana has a query. Yes, Archana, please go ahead. Yes, Archana, please go ahead. What
Sir,
is
good
your
morning.
query? Good morning.
Sir, I just want to understand the calculation of here, the discount at the rate 8% PV factor.
Mm-hmm.
Where does the amounts come, sir? Like how the calculation?
Okay, so if you look at this file, okay, which is currently on the screen, if you go to page number 6.20, okay, so this
Yeah.
6 lakhs, you understand how is this calculated?
Yeah, sir.
Okay, so now how do you get this 4,41,000? Very simply, this 6 lakhs you multiply with the PV factor, which is already given to you in the question. So if you go back to the question, okay, so it's already there. So you don't need to compute this. It's already there, right?
So
Now
do PV factors will be
let
given in the
us,
question?
yes, just a minute. Now, now let us try to understand what is this PV factor, because as I can also see some of the other queries coming up around the PV factor only. Okay, so what is the meaning of this PV factor? As regards this PV factor, this is given to you in the question. Okay, Anjana, I'll come to your query again. Don't worry. Huh? I'll come to your query. Now, what is the meaning of present value factor, which is given to us in the question? Let me just try to conceptually explain this point. Huh? See, it says, if let's suppose there is rupee 1, at the end of each year. Okay. So now, at the end of each year, if you have rupee 1, now, what do you need? You need to compute the value of that rupee 1. So let's suppose this is rupee 1. Here again you have rupee 1. Here again rupee 1. Here again you have rupee 1. Here again you have rupee 1. Now, if let's suppose you have rupee 1 at the end of each year. Now, what will be its present value? Okay, what is going to be its present value? Now, in the first year, what is the amount that you will earn? 6 lakhs. Okay, so that's why in the first year, what will be the expectation of the employee, or what will be the liability on the part of the employee? Entity will think, yes, employee has earned 6 lakhs and this 6 lakhs will be payable to the employee after 5 years. Yes or no? So I'm talking about first year only. So let's suppose employee has completed first year. Now at the end of first year, entity will say, now I have incurred a cost of 6 lakhs. But when is that cost payable? At the end of 5th year. So this 6 lakhs is payable in respect of first year of service. Yes or no? So will the entity recognize this 6 lakhs at the end of first year? It can't do that. Why? Because this 6 lakhs is the future value. So that's why what will the entity do? Entity will compute the present value of this 6 lakhs at the end of first year. Okay. Now what do we understand? This 6 lakhs is required to be discounted up to what year? End of first year. Over here, this is required to be discounted. Okay. Now for this, we can look at the concept. If let's suppose, say, we are standing at the end of year 1, let's suppose. Okay. If let's suppose we are standing here and at the end of 5th year, there is rupee 1. So what is going to be its present value as at the end of first year? So that present value as at the end of first year for rupee 1 future value, for a future value of rupee 1 at the end of 5th year, what will be the present value? So that comes out to 0.735. Okay. So if 1 is the future value, and if you compute present value of rupee 1, when do you compute the present value of rupee 1? As on today. As on today is what? End of first year. And when are you looking at that rupee 1? Future value. When is that future? At the end of 5th year. If you discount it, what do you get? 0.735. Now, is this calculation we are required to do? No, it's given to us in the question. So that's why when you have this value for rupee 1, you will apply the same value to rupees 6 lakhs. So therefore, what do you get? 4,41,000. Okay, now next year, again, same thing will be repeated. Next year again, management will say 6 lakhs is the expected cost which is added to the cost of this particular retirement benefit in respect of this particular employee. And this 6 lakhs, once again, is not payable at the end of second year. This will be payable at the end of fifth year. So for this 6 lakhs, now what do? This 6 lakhs is the future value at the end of fifth year. And when do you need to discount it? At the end of second year. So that's why now when you consider the discounting, you don't consider the discounting for 4 years. Now you will consider the discounting for 3 years. So that's why will you take the PV factor of 0.735? No, you will take the PV factor of 0.794. 0.79. So this is how all of these calculations will be done. Archana, clear on this? Yeah, I'm assuming you're clear. Anjana, please go ahead. If you can just. Anjana is asking, sir, how is this 6 lakhs calculated? See, this 6 lakhs is very simple. I think you have missed out on the first part. If you look at the question, it says, today salary amount is what? 14,90,210. Okay. It is expected that the salary will grow by 10% each year. So if you pick that growth of 10% each year, where do you reach after 5 years? 24 lakhs. Okay. Now, once again, you need to read the question. Question says, on the last drawn salary, means on 24 lakhs. What do? Pick up 25% of that. Okay. So if you go to the calculation, so what do? 24 lakhs means 25% of the last drawn salary. For how many years? For 5 years. So the amount of retirement benefit. So this is the method for calculating amount of retirement benefit. How do we know? Given to us in the question. So the total retirement benefit amount, this is how you will calculate. So what does it become? 30 lakhs. Now this is the total retirement benefit amount for 5 years. Okay, so this is for 5 years. So that's why, what do? Each year you will allocate. So you'll say each year, what is the amount? 6 lakhs. Okay, and that's why you will not take 6 lakhs. You will compute the present value of 6 lakhs when you record it. Clear? Yeah, Anjana, clear on this? So I think Kuldeep, once again, if you can just speak up. See, it's important if you can just explain your query. Otherwise, it's very difficult to
Sir,
understand
okay, okay,
the
okay. Okay.
process.
Yeah, clear, clear, sir.
Clear? Okay. Anjana, Theosami, you're okay. Anjana is also clear. Archana, I'm assuming you're clear. Theosami, you have a query. Anil, you have a query. Theosami is also clear. Neeraj is also clear. Anil is also clear. Good. Yeah. So I'm just hoping everyone is clear. See, this is, I would say, a good example. Why? Because it covers two components of the defined benefit plan cost. All the components are not covered. In fact, if you cover all the components, so what will happen? This will become quite comprehensive. Okay. But as far as the understanding of the concept is concerned, I think this will help you to a great extent. Yes, Anjana, you have a query? Please pick up. Anjana, please pick up. Okay, Meenu is clear on this. I think Vikas, you have a query? Vikas, if you can just speak up, explain your query quickly. No, clear. Anjana, Vikas, you're clear. Anil, yes, you have raised hand. Please pick up. Yes, Anil, please pick up fast.
Sir, we are taking into consideration inflation, right?
We don't know whether it is inflation or inflation plus some other factor. We don't know. And do we need to know about it? No. So it doesn't matter.
Okay,
Okay. So to say
okay,
10% is the
thank you.
inflation or inflation plus some top up, we don't know. Okay. And that is not really relevant. That is not really important for us. Okay. That's the growth
Okay,
which
sir.
the employee is getting and employee is happy with this. That's the arrangement between these two.
Okay,
Okay.
okay, sir. Thank you.
Sure. Vikas, you're clear? Then we'll move on to the next one, please. Okay, Vikas is clear. Then I think we can pick up one more example. Okay. Well, let's look at one more. All right. So if we go to this question number 4 now. Okay. So I'm moving to question number 4. Right. So you need to answer this, please. Okay. I would appreciate if you can just explain this. Okay. Small question, but in a way we'll be looking at the concept over here. Whether an entitlement to earned leave which can be carried forward to future periods is a short-term employee benefit or a long-term employee benefit. Yes, over to you. If you want, you can also speak up to explain, or if you want to send the answer in the chat box, you can send it over there. Harsh says long-term. No, so I don't want the answer whether it is short-term or long-term. I'm looking at an explanation. So if you can just explain this, that will be helpful. So why short term? Why long term? Quickly, over to you. Okay, so Minu says, sir, if it's within 12 months, now what do you mean by within 12 months? There again, you have not defined. If it's on after 12 months, it's long term. There again, you are not clear in terms of, okay, from the balance sheet date, is it? All right. What if it's both? What do you do? Tell me. What if it's both? Then what do you do? Where do you go? Tell me. Possible or not? Yeah. So what do you do in such a case? Yes, quickly. Who will answer? Okay, great. Adil says, because it's carried forward, or in case it's carried forward after 12 months. No, but we don't know it's after 12 months. Question says which can be carried forward. So if you look at the question, it is only saying can be carried forward. So period is not defined over there. But are you trying to say that after 12 months it will be long term? Okay. Minu says something which is unavailed. No, of course, we are talking about unavailed. So that's why it's carried forward. Otherwise, why will you carry forward? Okay. Yeah. Okay, good. Shamli has explained short term if the carried forward leaves are used or encashed within 12 months from the end of the period. Now, which period is that? See, I can see most of your responses wherein it appears you have the clarity. Okay. But the terminology, the words you are using, therein the answer is not complete. See, every time when you answer this in the exam, it is important that you bring in the clarity, because if you say 12 months from the end of the period, now which period is that? Okay, that's important. Otherwise, you'll lose marks. Neeraj says short term because earned leave is used within 12 months from the balance sheet date. Now, once again, we don't know whether it's 12 months or more than 12 months. Okay. Harsh says entity must estimate expected timing. Very good. So this is what the entity will have to do. Anchana says if it is carried forward for less than 12 months after the end of the financial year, then it is short term. Yes, that's correct. And what about long term? See, when the question is silent, in such a case, what should you do? You will have to explain about everything. Okay, you can't say that if it is short term, then this is my answer. You also need to speak up about long term, that if it is long term, then this is my answer. Okay, you'll have to bring in both the parts. Otherwise, in a way, you are only answering it partly. You are not answering this completely. Okay, so that is again important. Then I think Ishwarya has a solution. So, okay, she's saying it can be both long term and short term, right? Again, depending on the term that you use, you need to look at it. I think same is the response from Ridive. Yeah. Okay. So I think some of you are answering this in part. So that's why maybe you are answering it this way. So let's look at this. Now, short-term benefits are what? Which fall due wholly within 12 months after the end of the reporting period. Now, in this case, important thing is to check when does this employee benefit becomes due for payment. Yes or no? If it is expected to be paid, okay, within 12 months from the balance sheet date, so you'll call it as short term, right? But if let's suppose the expectation is what? Some part will be carried forward to the next year, and next year some part will also be utilized, means that will be availed. So that's what is short term. Okay, now this is something which is important for you to consider. See, let's suppose, I think we already discussed this, but let's suppose, say this is 31st March 2025, and this is also the reporting year. Okay, now next year, what will you have? 31st March 2026. Now, if let's suppose employee gets 21 leaves, out of which 16 leaves are unavailed. Okay, so what is the leaves which are required to be carried forward? 16. Now, in this case, because these leaves can be carried forward to future years, so do we know whether these leaves will be availed in the next year? We don't know. So how do we say that some part will become short term or all of these will become short term? We don't know. Or do we know in advance that these leaves will be availed after next year, means during this period? This is again not known to us. So same goes with the entity. So entity will also not know about it. So that's why, what do we need? We need an expectation. So entity will have to estimate how many leaves will be availed next year and how many will be availed next to next year. So this is what the entity will be required to do. Okay. Only then you will get to know what falls due next year. Okay. And what falls due after next year. Yes or no? Yeah. Only then you reach that number. Otherwise, you don't reach that number. Otherwise, you will miss out on that. Yeah. So we need to ascertain these two things, for which estimation will be required. So this is something you'll have to do. This is something you'll have to look at. Clear? Clear on this? Yeah. Any questions? Any doubts if you have on this? Over to you. Any questions? Any doubts if you have? Minu is saying yes. Anil, please go ahead. Please pick up. Anil, please go ahead. Please speak up. I think you want to speak up.
Sir, it's ultimately short term, right? Because the employer has to presume that employees will opt specific leaves, and they have to record the short term benefit, right?
No, there's no such fact pattern which is available to us, basis which will assume that it will always be short term. So what makes you say that this will always be short term? We don't know. That's why we are saying employer will have to estimate. Employer
So
will have
then
to
there
estimate.
will be a lot of, I mean, employees can do some tax evasions and all, right?
Employees, how can the employees do the tax
Sorry,
evasion?
employers.
So
Sorry.
how can the employer do the tax evasion? I couldn't understand.
Like he estimated somewhat
So whether it is
like
short
he
term
might
or
expect
long term,
estimate.
okay, in both the cases, will that be an expense for the employer or not? Answer is yes. Whether it is short term or long term, will that be recognized by the employer in the reporting year? Answer is yes. So what is different? Nothing is different. In both the cases, it is getting recorded. So it's not that if it is short term, it will be recorded. If it is long term, it will not be recorded. There is no such understanding. Both these costs are required to be recognized. Yeah. So there's no sort of manipulation which the employer can do basis this. The only point is that to say that this entire amount will be payable next year may not be appropriate. Why? Because otherwise unnecessarily employer will inflate the amount of short-term employee benefit. Okay, so that's why
Okay.
estimation technique is required, and that's what every employer will want to do. Okay, which is a fair basis of recording it.
Okay.
Yeah,
Okay, sir. Thank you.
sure. All right. Anyone else? Any more questions on this? No? Everyone clear? Okay, so Minu is saying actuaries estimates PUC. No. So see, PUC method you will not do when it comes to short term. But when it comes to other long term, of course, therein you will apply PUC method, actuarial valuation. So you'll have to go by the requirement of the standard. So in this case, we have this clarity available in the standard itself. So if the standard is giving you clarity We don't need to assume how to compute the amount. Okay. Okay. Archana is asking how to answer these type of questions. See, there are two ways. I've explained this to you. One, of course, which is there on the screen, just to get some more clarity in terms of the concept. But the way you will write it, the way you will put it out, okay, in the exam, you'll have to explain this, for which the solution is given in the study material. That too we have discussed. Okay, so that is how you will have to answer. But of course, while answering this, if you want to present it with the help of an example, you can always do that. That's up to you, and that is again dependent on the weightage of the question. So every time there is a question, you need to look at the weightage, and accordingly you'll decide as to what is the explanation you want to include, whether you want to top it up with an example or not. All of these things you'll have to decide accordingly. Clear? Archana, clear on this? Yeah. All right. So let's pick up some more questions. Just a minute. So now I'll just share this presentation up. Okay, we've got some small examples in terms of some of these concepts. So let's discuss that. I would appreciate if everyone's can answer. Okay, so let's look at this. Indigo Manufacturing Company produces heavy machinery products. Okay. Employees of Indigo are covered for any long-term disability resulting due to an accident in their normal course of work. The level of benefit due to an employee of the company does not depend on the length of service. So it is the same for any disabled employee regardless of the years of service. Okay. Now, on December 22, 2014, an employee of Indigo suffered a serious injury resulting in a long-term disability. Tell me, how should this cost be recognized? When should this cost be recognized? Over to you. Quickly, your thoughts. What do you do in this case? How do you recognize? When do you recognize? Quickly, what do you do? How do you record? Yes. How do you record this? Okay, Neeraj says it should be a benefit to be recorded as a liability as at the year end 31st March 14. Okay. Ridhiben says long-term liability. Anil says based on past data. No, which is based on past data is correct. But the question is what type of employee benefit you will consider and when means. Okay. So when do you recognize it? That is again one of the part of the question you need to answer. Shamli says when the liability is accrued. Okay, that's a very generic answer. When do you accrue this? That you need to specify. Tejaswami says long-term disability benefit. Kuldeep says it will be recognized as short-term because it is given irrespective of the length of service. So let's look at this. Since the level of benefit does not depend on the length of service, therefore, what do? You will recognize this as a cost of benefit on the day when this sort of event has occurred. Yeah, being the date of the accident. Clear? Now, will the answer be different if the company had a scheme where the level of benefit depends on the length of the service? In such a case, it has to recognize each year cost of benefit. Yeah, considering what probability of the payment that will be required and length of time for which the payment is expected to be made. Now, in this case, let's look at this one. Employees accumulate annual leaves over each calendar year. Now, please understand it's a calendar year, not a financial year. Okay. They can take their accumulated annual leaves at any time or carry it forward indefinitely. So no period is defined. So they can carry forward it till retirement. Accumulated annual leaves must be paid up in cash in case of departure. So when the employee will leave, let's suppose, and whatever are the annual leaves which are accumulated unavailed, so the cash will have to be paid. If those are unavailed, means those will not lapse at the time of retirement. Either the employee will avail it up to the retirement or will get cash against that. Experience means if you look at the past history, experience demonstrates that the employees use their accumulated annual leaves over a period longer than 2 years. Okay. Over a period longer than 2 years. So if you look at the past history, this is what is generally experienced. In this case, how should the unused accumulated annual leaves be classified? Means, how will you record it? Over to you. Yes, quickly. How will you record it? Quickly, huh? How will you record it? Short term, long term, post employment, termination. What do you call it as? So that is what you call as classification. And the reason, please. Huh? And the reason. Okay, good. Neeraj, Ridhiben, Meenu, I think Archin, they are all saying long term. Archana says it's short term. Good. Siddhi says it's long term. Can you give me the reason also? Anil says it is clearly mentioned that the estimate is employees use their accumulated leaves over a period longer than 2 years. So that's why it should be long term. I think Anil has tried to explain this. Very good. Pooja says it's short term. Adil says it's long term. See, I think it is very much clear. In the question itself, answer in a way is given to you. And still, if you are saying short term, I don't understand the reason for that as to why you are considering this to be short term. Okay. Very, very difficult to understand that point. When the question says it is expected employee will take it beyond 2 years. So will the entity be required to pay this within 12 months from the balance sheet date? Answer is no. So can it become short term? No. So if it can't become short term, where do you take it? Is it a post-employment retirement benefit? No. Is it a termination benefit? No. So what is the residual category in a way? Other long term. Correct? Clear on this? I think Navnita is also saying it's long term. Teyasumi has explained this. Yeah. Okay. I think Meenu has also explained. All right. Good. Clear? Okay. So now let's look at this. An entity grants employee B a long service leave if B provides 7 years of continuous service. Now, this is important. First of all, you need to understand the employee benefit. So every time you have an employee benefit, first of all, try to understand the nature. What is the nature? And then you get on to the accounting. Okay. An employee gets a long service leave provided he or she completes 7 years of continuous service. So that's the employee benefit. Or you can say this is the policy, HR policy. This is a benefit which the company provides. After 7 years of service, B becomes entitled to payment of long service leave if the employment is terminated. It is not expected that B will terminate his service or take his long service leave entitlement in year 7 or next year. Now, currently, we are at the end of 7th year. At the end of 7th year of continuous service, should this long service leave be classified as short term or long term? Over to you. I think a very simple one, provided you understand the question. Will you call it as short term or long term, and why? Pooja says long term. Teosimi says long term. Pooja says liability for long service leave should be measured at present value. Okay. Adil and Meenu are also saying long term. Ishwarya says it should be treated as long term. Why? Because it's not expected to be availed neither in 7th year nor in the 8th year. Yes or no? I think Pooja has explained this. Siddhi is also saying long term. Prerna says long term, provided completion of the provided is there because we are at the end of 7th year. So there's no provided. We are knowing the fact. Okay. Archana says long term. Neeraj says long term. Okay, good. I think everyone is clear on this now, which is good to understand. Yeah, very good. So in this case, it's a long term benefit, right? Why? Why it's long term? Because within next 12 months, it's not expected to be availed. It will go beyond 12 months. So that's why it's long term. And how do you record it? Of course, here you do the actuarial valuation, wherein this sort of discounting and all will come. Right? Clear on this? Yeah. So I think now what we can do is just to practice. Okay, maybe we can just pick up one or two more questions. Let me just see which one is the one. I would say if you can just try to solve this, that will be great. Okay, so now what I'll do is I'll pick up this question. Okay, no, okay, so over to you. All right, so I picked up one more. Again, if you go to the study material, a company has a scheme for payment of settlement allowance to retiring employees. Under the scheme, retiring employees are entitled to reimbursement of certain travel expenses for class they are entitled to as per the company rules. And so this is one benefit. and to a lump sum payment to cover expenses on food and stay during the travel. So one, they will get the reimbursement of travel cost, first AC, second AC, third AC. Okay. Or again, different classes would be created. Plus, they will also get one lump sum payment. What is that for? For when they travel. So they will have some expenses on food, stay, just to cover up. Okay. So this is the scheme of the company. Alternatively, means instead of getting this, employees can claim a lump sum amount equivalent to 1 month pay, which is last draw. Okay, so that is also a choice available. Either the employee can get this reimbursement plus this lump sum payment on as regards food and stay. Otherwise, what they can do is they can just simply ignore this part. What they can claim is a lump sum amount. Okay, which will be computed based on what? Last salary which they will be drawing. Okay, so that 1 month salary they will receive. Right? So this is the employee benefit. Okay. Now, companies' contentions in this matter are: first, settlement allowance. Okay, so this settlement allowance. So this benefit is called as settlement allowance. Does not depend upon the length of service of the employee. It is restricted to employees' eligibility under the travel rule of the company or where the option for lump sum payment is exercised equivalent to last pay drawn. Since it is not related to the length of the service of the employees, it is accounted for on a claim basis. Means as and when claim will come, it will be given. Right? Okay. Now, state whether the contentions of the company are correct as per the relevant accounting standard. Give reasons in support of your answer. Over to you. What do you think? Quickly, over to you. What do you think? How do you record it? How do you record it? Tell me, how do you record it? Okay. Radhesham says it can be defined as long term or short term as per time, of availment of employee. Okay. I'm not clear on this. You are saying it can go either way, but I would say some more explanation you need to maybe provide in this. Pooja says it's a retirement benefit. No, of course it's a retirement benefit. But I think the question is asking you about the contention of the company. Do you agree with that or not? Do you think what the company is saying is correct or incorrect? That is what you need to explain. Anil says employer has to record it as short term because it is not dependent on the length of the service. Okay. Tejaswini says due to the lump sum payment, settlement allowance is to be the retirement benefit. I think Ishwarya says post-employment benefit, defined benefit plan, since it is retirement benefit and the company is correct. Adil says it's short term. Anil says no, I don't agree with the contention of the company. Riddhi says it's retirement benefit. Okay. Anyone else? Any more thoughts on this? Okay, good. Vikas says, sir, it's short term. last pay salary to be seen for the provision. So let's look at this. Okay, so let's look at this. See, the present case falls under the category of defined benefit scheme, where the payment promised to be made to an employee at or near retirement presents significant difficulties in the determination of periodic charge to the statement of payment. Contention of the company that settlement allowance will be accounted for on claim basis is not correct, even if company's obligation under the scheme is uncertain and requires estimation. So what does the company need to do? They need to estimate. Assumptions may have to be made regarding the future conditions, future events. Okay. Therefore, settlement allowance payable by the company, what do you call it as? Defined retirement benefit. Okay. A provision should be made for this every year for the accruing liability on account of settlement allowance. Amount of provision should be calculated according to actuarial valuation. So that is again very important point, because that is something which is the, you can say, sort of attached requirement. Okay, the moment you say it's a type of benefit which is post retirement or this defined retirement, so actuarial valuation will come into the picture, where however the amount of provisions or determined is not material. The company can follow some other method, which is fine. Okay, so company can always ignore it on the grounds of materiality. Company may say that this amount is not significant, so that's why I'll want to follow maybe some other mechanism. Can it be done? Yes. See, if you go by the materiality, if you look at the amount, and if that is not significant, that is a small amount, and if let's suppose that is not done as per what the accounting standard requires, will that be okay? Yes, one can accept it. Why? Because its impact will not be significant on the financial statements. So that sort of, excuse can always be available, but that's not the right principle anyways. Okay. Yeah. So I think before we move further, maybe we can just pick up one or two more questions. But anyways, what we can do now is let's take a break, right? And I think somebody is no. Okay. Yeah. So don't have further queries. Okay. So now, all right. So let's take a break and let's continue after the break. Huh? Okay. Nisar, let's take a break. All right. Okay, so now I think let's pick up one more question. Okay, so if you go back to the study material, I think we can pick up this question number 9, right? Fair value of plan assets of Anupam was 2 lakhs in respect of employee benefit plan as on 1st April X1. Okay. On 30th September X1, plan paid out benefits of 25,000, received inward contribution of 55,000. On 31st March X2, fair value of plan asset was 3 lakh. On 1st April X1, company made following estimates based on its market studies and prevailing prices. Interest and dividend income 10.25%, realized gains 3%, fund administrative cost 3%. So expected return they are assuming is 10.25. You are required to calculate expected and actual return on plan assets. Quickly, over to you. I think we have covered a similar sort of question. So it's up to you now, okay, for you to solve and share the answer. Yes, quickly, over to you. You can solve this and let me know what is the answer you are getting. Okay, quickly, I'm just hoping you are onto this. Two things you are required to calculate. Expected return in terms of amount means what will be the expected return on plan assets and actual return on plan assets. Quickly, please solve this and you can just start sharing your answers. If you've got the expected amount of return, you can let me know. Yes, waiting for you to solve. Okay, so I can see this response from Archana. Archana has solved this partly. She's getting expected amount of return 22,000. Good. Shamli has a slightly different amount, expected return 22,037. Okay. What about others? Quickly, what is the expected amount? What is the actual amount of return you are getting? Okay, so Adil is also getting 22,000. Okay. Neeraj is getting actual return 70,000. Very good. So Adil is saying if I take 5%, so I understand why there is a difference. Maybe in some of the cases you are doing rounding off. Some of you are not doing that. Okay, which is fine. Minu is saying 22,037. Tezumi is getting 22,000. Harsh is getting 22,000. Good. So Archana is also getting actual return 70,000. Shamli has the same answer. Correct? Yeah. All right. So let's move on to the solution now. I think we have looked at it, but quickly I'll just run you through this. So now when you compute the return, so what do you do? On the opening balance, 2 lakhs, you will compute it at the rate 10.25. It's 20,500. Okay. Plus during the year, there has been an inflow or outflow on which you will compute it for half year. So it's 1,500. So that's why net amount that you get is 22,000. But if you pick up the exact rate means 5.125, then of course some portion of 37 I think which some of you are getting will be added, which is fine, absolutely fine. Okay, so then I think Ridhiben is also getting 22,000. Mustafa has shared the calculation. He is also getting 22. Ashwini is also getting 22 as well as 70,000 as the actual return. Very good. Okay, so now if you look at the actual return, now for the actual return, what do? You'll have to just sort of compute it as a balancing figure. So fair value at the end is given. From this, you'll reduce the opening balance, you'll reduce the contribution, okay, which you have received, plus you'll add the payout. So what do you get? 70,000, right? Simple, easy one. Okay, now let's look at one more. Okay, so let's look at this one. Question number 8. Okay, I think these are all for practice. Sheikh is also getting okay, so this is Sheikh is also getting 70,000. Prerna is also getting 70,000. Very good. Very good. It's good that you are attempting and getting the right answers. Very good. Okay, so let's look at this question now. Okay, last one, then we'll move on to the next topic. Following data apply to X Limited in terms of its defined benefit pension plan for the year ended 31st March X2. You are required to calculate actual return on plan assets. So what is the data? Benefits paid during the year, 2 lakh. Employer contribution, 2,80,000. Fair market value of plan asset at the beginning of the year, end of the year is also given. Okay. Now, in this case, you are required to calculate actual return. I think a very simple one, considering the one that we just solved, it's quite simple. Okay, so Neeraj is getting 3,60,000. Ridhiben, Ashwini, Shamli, Tesumi, they are all getting 2,60,000. Pooja is also getting 260. What about others? Adil is getting 360. Prerna is getting 260. Sorry. Prerna, Archana, they are also getting 260. What about others? Pooja is getting 260. Khushbu is also getting 260. Okay, so I think Meenu, Aditya, and Shaik, they are also getting 260. Neeraj is also getting 260 now, which is fine. Okay. P Mujahid is also getting 260. So I think again a simple one. Yeah. Everyone getting the answer and the same answer. So let's look at this. In this case, only the walk is required. So you've got the opening balance to which you'll add the contribution. You'll reduce the payout. So 880 is the balance that should have been there. But actual balance is what? 1140. So this balancing figure is what? This must be the return. Yes or no? This must be the return which has got generated during the year. Correct? Yeah. So with this, we are through on employee benefits. Now we'll move on to the next topic, that is about provisions, contingent liabilities. Okay. So now any questions, any doubts that you may have, let's discuss that before we move on to the next one. Over to you. Quickly. Any questions, any doubts? All All right, so let me just open the document. Just give me a minute. Okay, so moving on to the next one. Now this standard is all about provisions, contingent liabilities, and a bit on the contingent assets as well. So we'll talk about it as to what is that. Now, what is the scope? So now this deals with all the items except for some of these things which are excluded, executory contracts, insurance, or if there are items which are covered by any other standard. Now, some of the terms are important to understand. And I would say the most important term is to understand the meaning of a liability to begin with. So liability, we all understand what is a liability. But how do we define a liability? So the standard says present obligation of the entity arising due to past events. So maybe some event has happened because of which an obligation has arisen on the part of the entity. Okay. And due to this obligation, what will happen? Some outflow of resources will happen. Okay. So that is what you call as a liability. So in case of a liability, what are the features? Two. There is a present obligation resulting from past event. Okay. So these are the, you can say, sort of features basis which you will decide whether it's a liability or not. Correct. Correct. Now, there is also an event which you call as obligating event. Now, what is the meaning of obligating event? See, obligating event means an event that creates an obligation. Okay. Obligation in respect of what? Outflow of resources from the entity. Okay. And which the entity cannot avoid, means entity will have no choice but to pay out. Okay. But to settle the liability, but to pay off the liability, or you can say there is no way the entity can avoid the outflow of resources. That is what you call an obligating event, right? Now, as regards this obligating event, obligation, some of these factors, why is this important? Okay, what is the relevance of this? See, this is important because of two factors. One, when we talk about liability generally, and when we talk about provision generally, so what do? We use these two terms interchangeably. Okay. But can we say that provision and liability, both of them are one and the same thing? The answer is no. Both of them are not same. They are different. So that's why if you use these two terms interchangeably, that may not be appropriate. Yeah, so that's why what should you do? You should be able to, first of all, understand the difference between these two, because actually these two are different items which an entity may have in its financial statements, in its balance sheet. Okay. And in relation of both of these things, if you talk about a liability or if you talk about a provision, both of them result in a what? Both of them result in an outflow of resources, which is generally recognized as an expense. Okay, so now let's try to understand the background with the help of some of these examples. During 2000X1, an entity XY has made lower amount of profits. However, to ensure that the EPS do not decline significantly, this entity does not provide for warranty amount, which should have been provided for. So what is the meaning of provide? Means entity doesn't record expense for warranty. Yeah. So this expense has been incurred, but the entity doesn't recognize it. Now you may be thinking, is it possible? Yes. Now, how will that benefit the entity? See, today entity has got lower profits. So what do they want to achieve? They want to inflate their profits. Now you may be thinking that what if they do that in the current year? So will it be a permanent thing? Answer is no. So you can say it's sort of manipulation. It's a kind of fraud which the entity is making today, but they are anticipating. They are anticipating in the future years, company will get good profits, wherein they will record this expense. So today they are recording. So today they are avoiding this expense. But are they considering to do this on a permanent basis? Answer is no. Okay. So thereby, what will the entity do? Today they will achieve their desired profits through manipulation. In the future years, when they will get good profits, they will be okay to adjust the expenses which have not been recorded today. So that is again a sort of manipulation they will be continuing with. Now, why can this be done? See, there are two categories of expenses an entity may have. One, an entity has received an invoice, let's suppose for some expenses, which need to be recorded as a liability. So can the entity avoid that? Answer is no. But in some of the cases, what may happen is entity hasn't received any invoice. Okay. But the entity has incurred the expense because the documentation, because the relevant documents are missing. So that's why entities are trying to avoid the booking of some of these expenses which have been incurred. Why? Because these are required to be recognized as a provision, not as a liability. That is where AS 29 comes into the picture. Why? Because it says the criteria for provision is what? It needs to be accrued. Okay. Yeah. So this sort of manipulation which an entity may follow or may want to do can be avoided. Okay. With the help of AS 29. Clear? Next. During X1, AB Shops has made a huge profit. Okay, so you can say it's an entity, has got good profits. This may have resulted in payment of taxes on these profits. So of course, if they will have profits, so what do they need? They will have to pay taxes. Further, AB Shop's management foresees challenges in operations in later years. And therefore, they are expecting in the future years their profits will be lower. Now, AB Shop did not create a provision during X2, which should have been otherwise made. However, to get the desired impact, AB Shop created the provision in X1. Since the intention of the management is not to reflect a true and fair view, AS 29 would have ensured appropriate provisions are made in X2 only. Now, what does it mean? Let's try to understand this. If let's suppose we are talking about 2 years. Okay, so there was one way we discussed an entity may want to manipulate the profits when they have lower profits today and they are expecting higher profits in the future years. There could also be a situation which is other way around. Let's suppose entity has got good profits, say in 24-25. Okay, they have a profit of 100, but management is expecting that in the future years these profits will be reduced. Let's suppose it will become 80, 70, 65. So the profits will go down, say 69. But the management has got two problems. One, they want to even out the profits. So they do not want their profits to go down in the future years. That's one. Doesn't reflect good on the part of the company. Second, if they show higher profits today, they will pay higher taxes today. So that's why, what can the management do? They can create a provision. Let's suppose of 30. So if they do that, their profit will get reduced to 70. And this provision, because this is not correct provision, this is incorrect. So what they can do is they can reverse this provision, let's suppose in next year. Say they reverse this by 20. So if they reverse the provision, profit will increase. Again, the remaining provision 10, they can reverse. Again, the profit will increase. Yeah. So these are also called as profit smoothing exercises, which is not appropriate, which the entity should not be following. Yeah. So that's why, what should they do? What should they do? They should be recording the provision in the correct year. Right? If they do that, then of course the profit may be higher or lower. Does it really matter to us? No. See, the idea should not be that the profit has to go up or the profit has to go down. Idea should be that right amount of profit is recognized in the books of accounts. Okay, so that should be the thought process. Correct? Now, there are few aspects around this provision as well as a liability. So let's try to understand those. I'll come to some of these terms slightly later. One, present obligation. So this standard talks about present obligation. Obligation, we all know. What is an obligation? Yeah. An entity determines whether a present obligation exists at the balance sheet date by taking account of all available evidence. Based on such evidence, Where it is more likely than not present obligation exists, entity creates a provision. Where it is more likely than not present obligation exists, entity discloses a contingent liability. Means where there is likelihood is less, I would say. Okay. Now I'll come to these examples slightly later. Next, past event. Now this is again an important feature. We talked about present obligation as well as past event in the context of a liability. Please remember, we haven't discussed anything about the provision as yet. So you may have questions. Okay, you may have doubts around provision. So we'll talk about it. Okay, as of now, we have not discussed that, right? So now, in relation to this liability, what is this past event? Now, this is again a very important thing. Why? Because it's a feature. Without this, you may not be able to assess whether it's a liability. So what is that? A past event that leads to a present obligation. That is what results in an obligating event. Otherwise, there will not be an obligating event. So that is one to begin with. Yes or no? For an event to be an obligating event, it is necessary that entity has no realistic alternative but to settle the obligation. Means that obligation should be unavoidable. Means it should be something which the entity will have to settle for necessarily. There is no choice but to pay. Right? Then I think Kuldeep is asking, sir, past event means activities for business operations. You can say yes. Yeah, but we are talking about it as to what does it mean. Okay. Examples of such obligations could be penalties or cleanup costs for unlawful environmental damage. Let's suppose entity is creating some damage to the environment. Let's suppose they are creating some air pollution, water pollution, which would result in a penalty to the company. Or the company may have to incur a cost to clean it up. Right? As a result of what? As a result of the activities of the company. So what are those activities which the company has already done? So that's why we are talking about past events. Due to these past events, what will happen? An obligation may arise, or an obligation has arisen on the part of the company, which will result in outflow of resources from the company. Okay, yeah. So that is what we call as past event. Correct? Now, third, probable outflow of resources. Now, this is again important. See, we discussed about past event. We discussed about obligation, which is resulting due to the past event. Now, what should this obligation result into? As we discussed, this obligation should result into an outflow of resources. Now, what are those resources? So you can say it could be cash, or it may be some cost which the entity will have to incur. Okay, so it is not necessarily that entity will always be required to pay some cash. If the entity is incurring some cost, that is nothing but a cash payment only. Yes or no? Yeah. So that's why when we are talking about present obligation, so that present obligation is in respect of outflow of resources. Okay. So these two are in a way attached to each other. Because if there is no outflow of resources, what is the obligation? There is no obligation. Yes or no? Obligation is attached to the outflow only. Correct? Yes or no? Clear? Now what we will do is we will try to understand. Okay, so is there any query? We will try to understand one sort of PPR analysis. Okay, let me just call it as PPR analysis. With the help of which we will now try to understand some of the requirements of this standard. So let me just call it as PPR analysis. Now, what does this PPR stands for? It says probable, possible, and remote. Okay. Probable, possible, remote. Now, please remember this PPR that we are discussing, you can say is the core. Okay, so this crux of the standard or this entire standard is what? PPR analysis only. So once you understand this, you can say you have covered this standard in some manner. Okay, yeah. So that's why it's an important thing. So wherever you get stuck, wherever you have asked, wherever you have questions, please ask me. Yeah, okay. Because it's an important part. Now, what is the meaning of probable? What is the meaning of possible? What is the meaning of remote? Let's try to understand all of these one by one. Probable. Probable means it's more likely than not going to happen. Means which has higher chances of occurrence. More likely than not. Or you can say in percentage terms, it is more than 50% chances. Because chances are what? Greater than 50%. Now, what is this greater than 50% is not defined. That is judgmental. Now, if somebody says that, is it 60%? Is it 70%? It is 85%, 92%? No. Okay, so this is judgmental. This needs to be thought through. For your purposes, you don't need to worry. Okay, you will be given the adequate information in the question. Okay, so you don't need to worry about it. Then, sir, how do we decide? How do we apply judgment? So for you to apply the judgment, most of the cases will not be required. But I'm just trying to explain you conceptually the way it is required to be done. But for your purposes, the question will provide you the relevant information. Okay. Now, what is possible? Possible, we can say, is a 50-50 situation. Means when the entity is stuck, they have no clarity as to what is going to happen. Okay, 50% chances are it may go in favor of the company. 50% chances are it may go against the company. Means clarity is not there. Okay, so you can say some sort of ambiguity is there as of now, or complete clarity is not there on the basis of the fact pattern which is available today. Means which is again dependent on the outcome of some future event. So this is what you see in case of possible. Okay, what does it imply? So this is what it implies. right? Then third is remote. Now, what is the meaning of remote? Which has less chances. Okay, less likely. Okay, it's less likely that it's gonna happen. You can say the chances are less. You can say something which is opposite to probable. In case of probable, your chances are good. Okay, or in percentage terms, we can say something which is lower than 50%. Now here again, what is less than 50 is not defined. It can be 40%, it can be 10%, it can be 23%. We don't know. There again, judgment needs to be applied. But for your purposes, once again, you don't need to worry about it. You will be given the information, the fact pattern, the relevant idea, okay, will be available to you. Now what we will try to do is to get the clarity on the concept. We'll pick up one example. Okay, because I think this can be best understood with the help of example, because some of you may still be confused. What is this probable? What is the relevance of these three terms? Okay, now let's try to understand with the help of one example. Okay, now say a company has received a tax demand. Means there's a demand from income tax department, say for 10 crore. This is what the company has received. In respect of a particular matter. Now, when the company will receive a demand, so what do they do? Will the company pay that immediately? It may not happen. Why? Because company may want to evaluate the matter first. Yes or no? So that's what the company will generally do. So company will want to evaluate the matter. What is this matter? Why the demand has been raised? Okay. Kuldeep is asking, is it actuarial valuation? No, we are not talking about actuarial valuation. We are saying income tax demand. Company has received demand for income tax. Okay, maybe some sort of assessment is done for a particular year, and this is the additional liability which has been observed. That is what you call as a demand. Means income tax is demanding the company to pay this much amount for a particular year post their assessment. Okay, post their findings. Yeah. So now in this case, what will the company do? Company will consult with its tax experts. So company may have either those tax experts in-house. Generally, if you look at large companies, okay, they will have some teams, they will have a relevant department to take care of these matters. Okay, who will assess this? So they will do the assessment and they will think through, they will get into the merits of the case as to, what are the chances. If let's suppose the company wants to contest this, company wants to get into a litigation. Okay, so will it be appropriate? What are the chances company will win? What are the chances company will lose? Or company may want to consult a third party. Okay, so the tax expert the company may consult with, or the company may do both, depending on again the matter which is involved. Okay, so this is what the companies generally do. In such a case, what becomes important on the part of the company is to assess the outcome. Okay, so in this matter, what is it that the company will want to do? Company will want to assess the outcome. Means what is the likely outcome? today the outcome is clear. Okay, if you talk about today, the outcome is clear. There is a demand, but when are we considering the outcome? If let's suppose company gets into a litigation. Okay, so what is going to happen then? In that case, let's suppose companies' tax consultants have advised that there is a good chance of company losing the case. Yeah, so there's a good chance that company will lose the case. So what do you call it as? Probability. Now in that case, will you have any specified percentages? So do you think the consultant will say 80% chances are there? No, that is again something which is based on the assessment, wherein the percentages don't come into the picture generally. Okay, but yes, it's something which is assessed, wherein the company will make the assessment what are the chances. The chances are good, company will lose the case, then what do you call it as? Probable. In which case standard says company should record this expense as a what? As a provision. Company should recognize a provision for this. Okay, so in this case, when the amount is probable, what will the company do? Company will recognize a provision. Okay, yeah, clear? Any questions? No? Sure? Kuldeep is saying full provision. Yes, of course. See, that is again dependent on the assessment of the company, whether full or partial. So I'm saying for any part or for any amount where the company says it's probable, company will have to pay. Where it is probable, company will have to pay. What will the company be required to do? Create a provision. So how do you create a provision? By recognizing that. Okay. So when the provision is recognized, what will be the accounting entry? Expense debit to provision. Yes or no? So what is the accounting entry company will pass? Expense debit to provision. Correct? Yeah. So this is what you call as recognition. Yes or no? Now, let's move on to the next situation possible. Let's suppose tax consultants, the assessment which they have done, management, they are not sure about this matter as on today. See, on the basis of current situation, on the basis of the factors which are available as on today, company doesn't have any clarity. They are saying as of now, anything can happen. Company may lose the case or win the case. Okay, to say that company will lose is not correct. To say that company will win is not correct. As of now, that clarity is not available. Not because the facts are not available, not because they have not been able to assess. They have done the assessment. Okay, but the situation is such, the factors are such that on the basis of current situation, that clarity cannot be provided. Okay, so this is what you call as possible. This is what you call as possible outcome. In which case, will the company be recording this expense? No. This will not be recorded. This will not be recognized. But because the matter is such, amount is such, and the clarity is not there that this amount may have to be paid or not. So that's why company will have to disclose this in its notes to accounts, in its financial statements. Okay, a disclosure in the notes to accounts will be required to be given with the name of contingent liability. So only a disclosure is required of what? So disclose as a contingent liability. Okay, or I should say only a disclosure is required as a contingent liability in this case. Clear on this? Third, let's suppose management has done the assessment and they are very clear. There are no chances company will lose. Okay. Very remote chances. Okay. Very low chances company will lose. Or in other words, we can say company will win the case. That's what they are expecting on the basis of their assessment. So what do you call it as? That is called as a remote situation. In which case, do we recognize a provision? No. Do we give a disclosure in the notes to accounts in the financial statements? No. So what do? We will do nothing. We will just simply ignore it. Okay. Ignore it in terms of recording that in the financial statements. Neither as a disclosure nor as a provision. Everyone clear on this? With this, what we have tried to understand is what is a provision? When is that required to be recognized? What is a contingent liability? And when do you disclose a contingent liability? And what is the situation when you will not be doing anything? Okay, yeah. Harivansh is asking, sir, please explain this third situation again. Remote. See, let's suppose company has done the analysis. Okay. Management has assessed based on its discussion with taxation experts that it's very less likely that company will lose. So if the company gets into the litigation, it's very less chances are there that the company will lose the case. Means company will win the case. So what do you call it as? Chances are, let's suppose 5% of company losing the case. So in such a case, what do you call it as? Remote. If it is remote, then you will not be recognizing a provision. You will not be disclosing a contingent liability. You will not do anything about it, right? Do nothing means what? Nothing is required to be done in the financial statements. Okay, means neither a provision nor a contingent liability. Right? So this is what we mean by doing nothing. Because one sort of working is already done, wherein the management has done the assessment. Okay, great. Neeraj is saying, sir, we did this in foundation the same way. Very good. So I think you should have complete clarity on this. Yeah, which is good for you. Okay. Then I think Sayed is saying prudence concept is not fully adopted. Why do you think so? Why do you think prudence concept is not fully adopted? I think on the basis of what we discussed, it seems to be completely there. Yes or no? Yeah. Any more questions? Any more doubts if you have on this? See, this part is important, PPR, because as we discussed, this forms the crux. If you understand this, then I think you will be able to cover this complete standard. in a way, or you can say broadly, this is what the standard talks about, over which we are going to have a detailed discussion in terms of the examples that we pick up in the next session. Yeah. But any questions, any doubts, if you think you have, let's discuss that. Over to you. Any questions, any doubts on this? No? Everyone clear? Okay, great. So Harsh is clear on this? Yeah. Harivansh is also clear on this? Very good. All right. So if you are clear, then I think this is it that we had for today. In the next session, when we meet, we'll plan to cover questions based on this. Okay. And also we'll try to sort of differentiate further between this provision and a liability. Okay. So with this, I think we can just conclude our discussion now, right? So thanks everyone for your time and for this wonderful participation once again. But please make sure that before we meet next, you revise this. Yeah, because on the basis of this discussion, we are going to continue with our discussion on the questions. All right. Thanks. Thanks so much. I think Nisar, we can close this.